Well, the relationship between stocks and bonds is actually telling us right now that when the demand for stocks is greater than the demand for bonds, the aggregate economic outlook for all market participants is actually net bullish like this year. Now, stocks can go up under net bullish conditions versus bonds, and stocks go down under net bearish conditions versus bonds. In 2011, my chart showed the demand for bonds relative to stocks. The ratio was rising for bonds in late spring of 2011, and it told us that the demand for economic fear was greater than the demand for economic confidence. The ratio favoring bonds began to rise in favor of fear 3 months before the market peaked and then fell over 18% that summer. Now, bonds clearly remain in a downtrend relative to the S&P 500, and individuals are investing in stocks versus bonds, and they feel confident about the future right now. Well, this relationship can certainly help investors predict turning points due to several reasons, and I will outline those. Number one, it is mathematically impossible for a change in risk between stocks and bonds not to show up in the charts. Number two, one does not need to worry about market forecasts for bonds versus stocks. This ratio and the market will tell you. Number three, this allows the investor to pay attention to, one, observable factual evidence, and number two, I think even more important, unbiased information that allows that investor an objective look at the markets, and then they can make decisions based on facts rather than the emotions of fear and greed. And number four, there is no doubt that the chart is very helpful in managing risk, and thus it allows one to participate in either risk-on or risk-off investments. Well, looking at the ratio this morning, I would expect this, that investors would keep a risk-on allocation in their portfolios, which would include exposure to U.S. stocks, emerging markets, and other markets like Europe, and no bonds in the portfolio. And they can do this until the ratio changes, and that ratio would then favor bonds versus stocks. But for right now, it's called risk-on, and those investors are investing in risk assets. For Money and Markets, this is Douglas Davenport. Thank you.